Hi and a very warm welcome to this week's edition of MFB News. I hope you've had a fantastic week, and for those of you with children on summer holidays, I hope they're going swimmingly, which would be quite apt. Actually, given the weather, sorry, that wasn't a deliberate pun, but now I think about it, fairly appropriate. Now, in terms of what we got for you this week, we're going to be doing our usual rundown in terms of what's been happening with the lenders. Mainly positive, a couple of negatives. It's all about balance, isn't it? But actually in the round, better news again this week, which is fantastic. We're going to be looking at whether landlords are actually increasing their rents in response to higher mortgage borrowing costs. We're going to be looking at the latest news on the housing market. And then finally, we're going to be diving into the Fleet's mortgages rental buy-to-let barometer, where they're going to talk about the housing market and the buy-to-let market rents and rental yields as well. So some interesting information to share with you there this week. Okay, so first up, mortgage rates. So look, it's been a pretty staid week in terms of what's been happening. Swap rates are largely stuck at kind of the same levels as last week. And as we said last week, we're not really expecting to see much change until we get the base rate announcement on Thursday. More on that in a second. Things have floated up ever so slightly. So currently, as of now, and it's Tuesday at about 2 o'clock in the afternoon, 2-year swap rates 5.506. 1 month ago, they were 5.835. So they've come down by circa 0.3%. 5-year swaps at 4.756 were at 5.001, so just tipping the 5% mark there. So again, we've seen a reduction of circa 25 basis points. Now, in terms of what we're expecting with the base rate meeting this week and the longer term predictions, the general school of thought is that we're looking to see, or expecting to see, a 25 basis point increase this week, so 0.25%, which would bring base rate up to 5.25. And then realistically, by spring of next year, we're expecting to have capped out at around 5.75%. There are some schools of thought which I think is going to go much higher to sort of circa 6.5%. We're not sitting in that camp. We think 5.75 is going to be where things kind of tip out. So now, as we know, when we had the recent inflation news, we saw swap rates come down. Some lenders' pricing then came down. Some lenders are also currently still reworking the numbers and amending their product pricing, and some lenders' rates actually went up. This is all going to be connected to their cost of funds. So not everyone is exposed entirely to the capital markets and swap rates. Some people have different kind of funding models. So these are all going to be kind of factored in, which is why you're seeing different lenders do different things. But we're not going to dwell this week on those lenders who have put their rates up. We're going to look at those lenders who have brought their rates down. So first of all, we have seen Virgin Money launch, and this is pretty punchy actually, some 7-day exclusives which are available until the 7th of August, so for a very short period of time. So when we talk about limited edition products, where lenders bring out a particularly good rate, they make it available for either a certain amount of lending volume, to say £100 million worth of mortgages, or it's available for a certain period of time. So 7 days is pretty short. I'm guessing Virgin are just doing to try and kind of give a quick injection of new business into their sales pipelines. So the pricing here, actually it's really good, from 5.25%, and this is with flat arrangement fees. Now, Virgin as a lender, they are very straightforward stuff, so up to 10 buy-to-lets in the background, personal names only, no HMOs, no multi-units, that kind of stuff. There's a couple of real niches in their policy, so no minimum income requirement. They can consider early remortgages, so remortgaging a property you've owned for less than 6 months. Not everybody can do this, and they can do it against market value, as long as we can kind of explain why there has been an uplift in value if that's the case. They're able to consider things like deck access as well. So, you know, a solid offering, albeit a very kind of vanilla offering, and some very good rates from Virgin. Now, Coventry have made reductions to their rates. So we have seen pricing from these guys. Variable pricing is from 5.6% now, and your fixed pricing is from 6.25. Coventry, Virgin, very similar proposition. Coventry probably slightly more conservative, so they're not doing day one remortgages as an example. But in terms of their appetite for the kind of borrower sort of shape, individuals only, no limited companies, that kind of stuff. Skipton, again, brought some pricing down. Their variable rates are from 5.64 and their fixed rates are from 5.97. Again, very, very similar in terms of appetite, maximum 10 properties in the background, that kind of stuff. So we have seen this week, which we hadn't seen last week, some pricing movement from the kind of more high street type institutions. Now, we have also seen in the specialist space some price movements there as well. So we've seen MT Finance drop rates by up to 0.64%. So their rates are now from 6.26. very specialist lender, MT Finance, absolutely wonderful at dealing with complicated stuff. HMOs, multi-units, landlords with large portfolios, quirky structures, all this kind of stuff, absolutely brilliant. So great to see them bringing their pricing down. What I would say is the 6.26 is right at the bottom end of their pricing range. Watch the arrangement fees. Similar story with Kent Reliance. So Kent Reliance actually have been repricing upwards. However, they have brought out some limited edition products, which are actually not bad at all. 2-year fixes from 4.89. 5-year fixes from 5.24. You know what I'm going to say, the fees are massive, so you know you might want to consider a slightly higher interest rate to avoid the larger fees, but it's all in the maths. And also personal preference, some people just will not pay high arrangement fees and some people just want the cheapest monthly payment, so there's something in there for everybody, which is great. Now, part of the same group as Kent Reliance, we've seen Precise Mortgages, who are also part of One Savings Bank, bring out some limited edition products. Their rates are from 4.69%. Now, you may sort of think, that's not very fair, is it? Two lenders in the same group and one's got better rates than the other. Why is that? So Precise are definitely more of a kind of vanilla offering. They can lend on small HMOs, small multi-units and limited companies, but very sort of clean structures. Whereas Kent are certainly able to take a bit more in terms of the property types, so larger HMOs, larger multi-units. They can consider layered transactions, day one remortgages, so slightly more racy stuff. So they're both fundamentally lending in the same kind of space, but Kent Reliance can certainly take on the slightly more quirky cases, hence the reason their pricing is just ever so slightly higher. Now, lastly, from the lenders, we've seen Vida reduce their rates by up to 0.4%, and they've also just cut down the number of rooms they're able to accept on an HMO from 8 to 6. Why they've done that, I really don't know. They haven't shared their thought process. Maybe they're just getting a whole bunch of larger HMO inquiries or cases coming in. Maybe their funders are feeling that they don't want to be exposing that space at the moment, who knows. But so if you have a Vida application going through and it's for an HMO of 7 or 8 rooms, don't worry, they'll continue to honour that. But actually, if you're thinking about applying and you've been looking at Vida rates and you've got a 7 or 8 bedroom HMO, these guys aren't going to be for you for the time being. We've also seen West One reduce their limited edition rates. Their pricing is from 5.4%. Watch the arrangement fees. Both Vida and West One specialist lenders, so HMOs, multi-units, limited companies, that kind of stuff. Now, in terms of criteria, there's been a couple of changes to rental calculations. So the first thing is that Coventry are now have increased the stress test they're using on the background portfolio when they're looking at that as part of their underwriting. So they've increased the rental calculation to 145% at 6.5%. So that's a kind of negative. In the positives, Kent Reliance have changed their rental calculation more favourably if you're doing a like-for-like remortgage. So like-for-like remortgage is when you're remortgaging to a new lender and you're not borrowing 1 penny more than the amount that you currently own. So in these situations, lenders are able to offer an element of flexibility in terms of the rental calculations. Kent are not the first lender to have brought this on board, but actually it's really great to see them doing it nonetheless. So that's kind of it from the lenders this week. I mean, it is a funny time of year, isn't it, anyway? We've got a lot going on in the kind of mortgage space, and then we've got the fact that, you know, it's very quiet in the summer holidays. A lot of people were away last week in this. So I think maybe we'll see more movement next week, but I think really the thing to keep your eye on for this week really is to watch base rate and then see how that falls out in terms of swap rate pricing, and then we'll go from there and see how the lenders react in the next week or so. Okay, now as a landlord myself, with 2 mortgages coming up in December, it's a real conundrum actually. So obviously I have this one buy-to-let property that you all know about, which had the non-paying tenant. That's an easy one, but I've also got a property which is a flat in Tunbridge Wells, where the tenants have been in there since COVID. They're absolutely amazing. They are no trouble at all. Lovely, lovely people. Now, my mortgage is going to increase significantly at the end of this year, and I'm loath to pass on the cost to the tenant because they've been so great. And I'm sure there are lots of other landlords who are in the same situation as me. So I was particularly interested in an article that I read in Landlord today, which was talking about this. So here's the research and the numbers for you. Some 18% of buy-to-let landlords have suggested they are not raising rents for tenants despite inflation and soaring mortgage costs. A survey which was actually carried out by the lender Landbase showed that 61% of landlords would be obliged to raise rents and 21% remain undecided. The research shows that over the past year, a majority, so 76% of landlords raised their rent primarily to cover increasing mortgage costs, with most attributing the rise to increased interest rates. Additional reasons for rental hikes included covering maintenance, repairs, increases in taxation or energy bills, and the habitual annual raise practiced by some landlords. Out of the respondents, 38% expect rent increases to range between 6 and 10%. just over a quarter said they would only raise the rent by a maximum of 5%. Some landlords admit they're absorbing losses to retain good tenants, while others are postponing rental increases. Now, it's such a broad range of numbers there, isn't it? So I really do think, I mean, obviously lots of landlords have been putting up rents. I think it's, you know, to cover all of those costs, but actually because I just think the market rents have increased so much. So obviously we know as landlords that you can't just simply whack up a tenant's rent indiscriminately there for an existing tenant. But when you take new tenants on board, you know, the kind of doors open up in terms of what you can charge people. So I'm sure there are lots of people who are saying, well, you know, this is the going rate for the rent. I'm hardly going to just charge less for the sake of it. So people are increasing their rents. But I do actually know that there's lots of landlords that I'm speaking to are saying that, you know, I've got this incredible tenant. I don't really want to put their rents up, or maybe just by a small amount, but I'm certainly not looking to kind of, you know, hike things up massively to kind of keep the same level of margin between my, you know, my mortgage costs and my other things, my profit levels. So I just found that a really interesting article that I wanted to share with you, and hopefully if you're in the same situation, it might just give you a kind of view of what your peers are up to at the moment. Okay, now the Nationwide has released their latest house price data. This just came out this morning, and this is quite an interesting one. So the average price for UK house was £260,828 in July, which is down by 0.2% on the previous month. July also saw house prices fall by 3.8% annually, higher than June's annual house price decrease of 3.5%, making last month the weakest outturn since July 2009. The price for a typical home is now 4.5%, almost £13,000 below the peak of £273,751, which was recorded in August 22. Just a year ago, I remember delivering those numbers. It feels like another lifetime now. Investors' views about the likely path of UK interest rates have been volatile in recent months, with the projected bank rate peak fluctuating between 5% in mid-May and 6.5% in early July. This is Rob Gardner, the chief economist at the Nationwide Building Society. So what he's saying, that there's been a slight tempering of expectations in recent weeks, but longer-term interest rates, which underpin mortgage pricing, remain elevated. As a result, housing affordability remains stretched for those looking to buy a home with a mortgage. And Gardner went on to explain that this affordability challenge was a big reason why the housing market activity has been subdued in recent months. So I don't think anything there is going to be kind of a great surprise to us. What I think is kind of interesting for you as landlords is that I've definitely had an increase in the number of clients phoning me up and saying, look, I'm not going to do anything just now, but I'm watching the market and actually we're getting ready to make some further investments. So landlords are waiting now for prices to come down a bit further. I think it's always very difficult to know where the bottom of the market actually is, but the point is that actually if you were to buy a property now, it would cost you 4.5% less than it would have done 1 year ago. So landlords are feeling a bit more kind of interested in investing, and when you particularly balance that in with the increase in rental figures as well. So really, again, I think, it's just one of those things that it's interesting to know what other people are doing. The expectation for the housing market more sort of broadly is certainly not things falling off the cliff, obviously on a downward trajectory at the moment, but actually the number of mortgage approvals is increasing, interest rates are starting to come off the boil. So I think actually we could be nearing the dip in terms of activity in the housing market. And as we know, activity is really what drives prices. So it could be that we're maybe nearing the bottom of the house price reductions as well. I'm really sorry, I'm doing a lot of reading off of paper today. It's because all of the articles and news we want to share with you is really number heavy, and I don't have like an auto cue. Maybe I should ask our marketing department to provide one, but I can't retain this level of numbers, so I'm afraid I'll have to read a bit, and this is going to be no exception. So Fleet Mortgages have recently done their rental barometer, which covers Q2 2023 rental yields in England and Wales, and actually it's just some really interesting reading. So the first kind of point to note is that all regions of England and Wales, the barometer shows an annual increase in rental yields for the second quarter in a row, with the total yield for both countries up from 5.6% a year ago to 6.3% now. This is slightly down on the previous Q1 2023 figures, which showed 6.5%. Increased yields continue to be the consequence of a number of factors, namely an ongoing shortage of rental stock, leading to higher rental prices, plus an easing in house price levels. So obviously if house prices come down and rental incomes go up, that then pushes yields up. Now, interestingly, there is an increase in annual yields across every single region. However, there was something of a split in terms of quarter-on-quarter changes, with only the North West, Wales, East Anglia and Greater London seeing an increase on the yields achieved in Q1 this year. The North East of England continued to retain its top regional rental yield figure for the 12th consecutive quarter, posting the same 8.6% yield as the previous quarter. However, both Wales and the North West jumped above Yorkshire and Humberside in the table, up 1.2 and 0.4% respectively on the previous year. East Anglia and Greater London have also moved upwards. So it's really interesting just to show which kind of areas of the country are doing particularly well in terms of rental yields. And some places continue just do really, really well, and other places it moves around a bit more. But if you are thinking, based on what I was just saying about house prices coming down, about investing, this kind of information I think is really, really useful to know. And that's me wrapping it up for this week. I hope that's helpful. If you have any questions, do give us a call, 0345 345 6788. And as always, there is a humongous amount of information available on our website. Be interesting to see where we are this time next week. I think things could have moved on again ever so slightly. So I'll be looking forward to reporting back then. But for now, it's just for me to bid you a great weekend, a fantastic week, and I'll see you again next time.